Today, we are diving deep into working capital. I mean, this is the absolute lifeblood of any business. It's the key to understanding a company's real day-to-day financial health, and it's how you go from just looking at numbers to actually understanding strategy. Okay, let's get into it.
So, have you ever seen this happen? A company posts these amazing, record-breaking profits. Everyone's popping champagne, and then, boom, they suddenly go bankrupt. It's this bizarre paradox that leaves everyone scratching their heads. So what's really going on here?
Well, here's the thing. The answer, 9 times out of 10, has nothing to do with profit. It's all about cash. You see, a business can be wildly profitable on paper, but completely run out of the actual, physical cash it needs to pay its bills, its people, and its suppliers. And that is the critical difference we're going to unpack today.
To get to the bottom of all this, here's our game plan. We're going to start with the basics. What even is working capital? Then we'll look at the different types. After that, we'll get into the really interesting stuff, positive versus negative working capital. Then we'll hit the pro-level metric, the cash conversion cycle. And finally, we'll wrap it all up with why this stuff truly matters.
Okay, first up, what exactly is working capital? Let's just break down the absolute fundamentals of a company's short-term financial pulse.
In the simplest terms, working capital is just the money a business has to have on hand to run its day-to-day operations. Seriously, think of it like a company's main checking account. It's a vital sign that tells you right now if a company has enough cash and other short-term assets to cover all its immediate bills.
And the formula for it? It's super simple. It's just your current assets minus your current liabilities. So, on one side, you've got your assets, things like cash in the bank, what your customers owe you, and all your inventory. On the other side, you've got liabilities, stuff like what you owe your suppliers and any short-term loans. The difference between those two? Well, that's your breathing room. That's your operational cushion.
But of course, it's not quite that simple. We've got to go a little bit beyond that basic formula to really understand what's going on. We need to add some nuance here.
So working capital actually comes in a few different flavors. Gross working capital is pretty straightforward. It's just the grand total of all your current assets. Net working capital is the one we just talked about. It's the most common one. Then you have permanent working capital. That's the bare minimum you need just to keep the lights on. And finally, there's variable working capital, which is the extra cash you might need for, say, the holiday shopping rush or a big one-off project.
So, all of this leads us to a really important question. Common sense would tell you that having more working capital is always a good thing, right? I mean, a bigger financial cushion has to be better. Or is it?
This chart really lays it all out. If it's positive, great, you have a cushion. If it's zero, you're on a razor's edge, no room for error. But look at negative. This is where your short-term debts are actually bigger than your short-term assets. Now that could mean you're in really deep trouble, or it could mean you're an absolute genius of efficiency. So, which one is it?
And that brings us to the big reveal. Is a negative number here always a huge red flag? The answer, which is pretty surprising, is not at all. And this right here illustrates a core strategic concept that separates the good companies from the great ones. Just look at this tale of two businesses. Think about a grocery store. It gets your cash the second you check out, instantly. But that grocery store, it might not pay its suppliers for the milk and eggs for 30, maybe even 60 days. It's literally using its suppliers' money for free to run its business. That's brilliant. That's efficient negative working capital. But then look at the struggling manufacturer. It might also have a negative number, but that's because it can't sell its inventory, and it's waiting forever to get paid. See? Same number, two completely different stories.
So how in the world do we tell the difference between a company that's efficient and one that's just in distress? Well, for that, we need to bring in a much more powerful tool. This is the cash conversion cycle, and it's all about measuring a company's speed.
The cash conversion cycle, or CCC for short, is basically the company's cash flow speedometer. It tells you exactly how many days it takes for a dollar invested in inventory to make its way all the way through the business and back into your pocket as cash from a sale. And trust me, the shorter this cycle is, the better. Now, the formula might look a little intimidating at first, but it's really just 3 simple steps. First, you figure out how many days your inventory just sits on the shelf. Then, you add how many days it takes you to actually get paid by your customers. And finally, and this is the fun part, you subtract how many days you take to pay your own suppliers.
Let's make this real. Imagine your inventory sits for 15 days. It takes you 2 days to collect cash from your customers, but you get to wait 12 days to pay your own bills.
Well, you do the math, and that gives you a cash conversion cycle of just 5 days. It takes this company only 5 days to turn its products back into cash.
And this is the mic drop moment. A negative CCC, that's the holy grail of business efficiency. It means you're collecting cash from your customers before you even have to pay your suppliers for the stuff you sold. Remember that grocery store we talked about? This is its superpower.
Okay, let's bring this all home. Why should you care about any of this? Because this isn't just about accounting. It's about the deep, strategic value of working capital.
Getting a handle on working capital is absolutely critical for a few huge reasons. 1, it just makes your daily operations run like a well-oiled machine. 2, it frees up precious cash that you can then use to grow and jump on new opportunities. 3, it makes you look way more attractive to banks and lenders. And finally, it's a massive tool for managing risk, giving you a buffer for when things inevitably go wrong.
This quote from Kotak Mahindra Bank just says it all, doesn't it? Working capital isn't just some boring term on a balance sheet. It is the fuel that keeps the entire business engine running smoothly.
So I'll leave you with this question to think about. The next time you're looking at a company, don't just glance at the profits. Dig a little deeper. Ask yourself, what does its working capital, and especially its cash conversion cycle, tell you about its hidden strategy, its true efficiency, and its real power in the market?